Okay, what I'm going to cover today is stop losses, and I'm going to focus on trailing stops. So I brought up Fever Tree. The reason I brought up Fever Tree is because it's probably one of the smoothest outlying trends we've seen in the market over the last few years or so. It makes a really good example, and it gives a good baseline to work off. This is what I would call a very orderly trend. Orderly usually means not so much lower beta, but just more sort of manageable, very structured and manageable. It makes for, using the old trend tool on ShareScope, you can just drag that full trend out there. It grew from a small cap into an efficient main market stock, as we know. It's a UK AIM 50 as we look at it now. It's, small caps tend to be twice as volatile in their trends as large efficient main market stocks, or lower beta sloths, as we call them at Trading Basis. The boring stocks, say the REITs, and just those boring kind of stocks what don't move very fast. But they tend to, the growth stock tends to be a lot more volatile, and I'm looking at one of the most orderly stocks in the volatile space, one of the most orderly trends. So, to repeat myself again, it's a good base starting level. Other growth trends are probably going to be a lot more volatile than this one, is what I'm trying to get out there in their swings. So, talking about stop losses, you'll hear people say, well, what's his name? William O'Neill says 8% stop loss. Edward Treetop says 10% maximum stop loss. First things first, you've got to remember these guys are talking momentum trading. They're not riding a primary trend. So if your job, if your methodology, whatever, how you trade, if you think you're a momentum trader, well, that's probably going to work for you. If you think you're riding, you're trying to capture big trends, well, it's not. It's clearly not. And I'm just going to show you why that is just not the case. The evidence is in front of our eyes. All we have to do is, take the market swings on this stock and, drop it in a spreadsheet and let's just measure it. First things first, always use a log scale. If you're comparing, current volatility with past, always use a log scale. It evens it out in percent terms. So I'll take the log scale off and you'll see it looks more volatile in the right hand side. I suppose if you're looking at a stock like this, everyone calls the top in a stock on a linear chart, don't they? You put a log chart on. ShareScope's just updating. You will see that, well, zoom it. I'll do it. Linear chart, log scale. So, comparing past data with current data should be, done on a log chart. Simple as that. So I'm just going to jump straight onto fever tree, and I've just dropped every high and ignore entry and stop. This is the high and this is the pullback low. So active high and active low of every swing. And this is the percent. So this first swing in fever tree from the IPO breakout was a 7.6% pullback. Common consensus, 10% maximum stop distance. Where does that get you knocked out of fever tree? I'll show you where it gets you knocked out of it. It gets you knocked out fever tree. On the second pullback, right on the lows. So straight away, well, that's not going to work, is it? So everything you've learnt about the 10% stop might as well just be thrown in the bin. If you are trying to ride for price appreciation over time, riding a trend, that isn't going to work. If you are a momentum trader and you're just trading little breakout moves, well, it's probably going to make a lot of sense. What about initial stop? Well, if you think you can time a small cap stock with a 10% stop loss, and sometimes you can, maybe you can get there. I don't do it that way myself. I hate being chopped up on small cap stocks with wider spreads. Is not how I approach it. I approach it wider brackets and I build into the position. So I build my size over time. I'll just bring the spreadsheet over again. You'll see second pullback minus 11.7, third pullback minus 11.1, fourth pullback minus 16.3, and then bang, 23.7% pullback. Guess what? This is a very orderly trend in a small cap stock. Next one, 25.5% pullback. Very orderly trend. Let's go and have a look where that gets you knocked out. 523. That's this one here. This pullback here. So straight away, it's not going to work, is it? If you want to ride this, well, you can re-enter. Yeah, of course you can. But, the job is, if you're riding a primary trend, the job is to capture a percent of the trend. And how much do you capture there? You probably capture about 26% of the full trend, maybe. It's not that much, is it, really? We move on again. We're down to 13.8 again. 16%, 10%, 10%, 12%, 10%, 10%, 27%, 18.16. It's probably this one, this area here somewhere. So that will be this low here. That it captures more than half of the move. Not bad. It's good to capture more than 50% of a trend. I would say you'd want to capture a bit more when you ride, to be honest. I would say, 66% is a good, area to, something good to swing for. And then we back down to 17.8, 15.3, 14. I mean, what is overwhelmingly obvious here is that one of the most orderly outlying trends in the UK market of recent times you know, a stop loss of 10% will not cut it. It just won't work. A stop loss of 40%, and this is where it actually did, it did end on that last pullback there. Well, that's too much. %27.5%, maybe, but I'm not here to just say this is the number you should abide with. I'm here to say this is quite an orderly stock, and this orderly small cap stock had 27.5% pullback before going on to do another how many percent? Another 100% move, more than 100% move, from 1816 up to 41.2. It did another 100% from that area is basically what I'm trying to say, before it finally did top. So, make of that what you will. What am I trying to get across here? What are you trying to achieve? Now, you'll see how active a lot of investors tend to be on the social media. They're in, they're out, they're in, they're out, they're in, they're out, they're in. That is not me. I buy and I hold for the trend. First entry, if it stops me out, it's just an entry and exit. Next scenario, entry, get to add, get stopped out, Next scenario, entry, get to add again, get stopped out, And next scenario, entry, get to add, got my full position and the trend, plays out. Exit. It's as simple as that. There's not going to be much trading on this time frame. I'm not trading in and out of my positions on this time frame. It's too boring for most investors. I will tell you now. If you're trading more than 20, taking more than 20 different trades a year, maybe you need to just have a little bit of a sit down and ask what you're trying to achieve in the markets. Or, every time I get the "you're a trader, I'm an investor" comment on the social media, I always have a look at how many trades they've taken. And I had it last week, and the person had taken about 5-6 trades in 1 week. If you're taking 20, 25 in a year, different positions, you're probably not riding the primary trend. It's just basic maths, isn't it? You're trying to ride these things for months to years. If you're investing, you're going to be dollar cost averaging from minimum of years to decades. And if you're a swing trader, you're going to be probably taking multiple trades a week. That is the reality. So just a little pointer to help people with how stocks actually trade. This is a pretty orderly one. What about this one? Ideagen. Well, this one's all over the chart, isn't it? This one swings up and down. So, different stocks will have different sort of volatility. Always have a look at the volatility. Some of them are just, you zoom the chart out and it's just chaos, it's just, even if they're rising, they can be rising in an unbelievably volatile fashion. And it will be hard to capture reward to risk. And this one is one, and I'm riding this one. But, just a little lesson in volatility there as well, just to tag on the end. And what you're trying to achieve, this should help people.